Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jakeandgino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, doing good. MIH.
MIH, baby. Always making it happen. Today's guest is Paul Moore. I'm going to keep it simple today. Paul is a multifamily investor whose company controls over $100 million in multifamily assets. Paul, that's a big number. Why don't you tell us a little bit about your story and how you got into real estate?
All right, great. Well, I had an engineering degree. Was misguided into petroleum engineering as a kid, and thought I wanted to drill oil wells. Got out. There was no jobs in that field, so I got an MBA at The Ohio State University in the 80s. I went to Ford Motor Company in Detroit. Really enjoyed Ford, but I just had this penchant for starting companies on the side. And so a buddy of mine and I started a professional employer organization, which was an HR outsourcing company. Quit Ford in early 90s, did that for 5 years. I was finalist for Michigan Entrepreneur of the Year a few times. And we sold the company to a publicly traded firm in the mid-90s. Retiring at 30 sounds fun, but I was a high-energy entrepreneur. We moved to the Blue Ridge Mountains, got 120 acres. We started an international student nonprofit organization where we basically connected with international students. We had them come from different universities around America, stay in our home, milk a goat, ride a cow, or maybe it was vice versa. It was a lot of fun. And basically did that for a while, but I got bored pretty quickly, and so started investing and started buying and flipping real estate, started building, did some subdivisions, basically made a ton of mistakes, went through a lot of pain. It was 18 more years of school, as I say, and not one I'd really necessarily want to repeat. But anyway, we're doing well now. My company, Wellings Capital, does not actually control 100 million plus in real estate. We actually have capital partners that asset management partners we work with that have that. We are a brand new entity, and we are just relaunching. We're actually launching a fund right now to purchase multifamily, and we're just in the process of launching that this month.
So, Paul, why real estate?
I noticed that, so originally I kind of fell into it because a friend of mine and I were both kind of bored in 99, and we basically looked at all the different options for wealth creation out there. I noticed that a large percentage of the Forbes 400 had made their money in real estate or sustained it in real estate, so decided that would probably be a good option. We started out by flipping homes. My first deal was we went to the courthouse steps on an icy day in December of 99, I think it was, or 2000. And we were the only people there bidding on a house. We bid on it. We got it for $34,000. We slapped Dakota paint on it, cleaned the carpet, and put it back on the market with a for sale by owner sign for $65,000. Sold it in about 3 hours. And I thought, this is going to be easy. I multiplied that by 24 and figured out we could do, 2 of those per month easily, right? And we'd be doing really well. Well, we lost money on the next 2 deals, and I realized it was not that easy.
So tell us, give us some pain stories of your, beginning in real estate, because usually when you start out good, that's not a good sign, because like you said, sky's the limit. I'm going to be great, and then all of a sudden, reality hits you, huh?
Yeah, I thought you only had 40 minutes.
I'll make it 45. I'll throw in another couple minutes for it.
No, I've got so many pain stories. They're endless. But no, seriously, we went from flipping homes to building modular homes. We built about 7 or 8 modular homes. We flipped 60 or 70 homes total over the last let's say a decade. We were building modular homes, and then I thought, well, if I can make money building modular homes, I can do better doing a stick-built home. And that was my first mistake. That was one of many, actually. And we hired a contractor who somehow stole the bulldozer I bought for the project. I'm not sure how I ended up buying a bulldozer, but this guy ended up stealing the bulldozer. He did the drywall wrong. It was a waterfront property. It was in the boom in waterfront, resort properties in the early 2000s, and thought, we should be able to make $100,000 profit on this house. Instead, we lost about $50,000, and so that's the
and a bulldozer.
That's right. Well, I included that in there.
Okay,
but it was used. So.
Did he drive it away down the street, or did he load it up on a trailer?
We don't know.
Man,
we haven't seen the guy since. So
where do you hide a bulldozer, man? Sorry.
Well, I mean, he convinced me that there was nobody at all in the region who could do the dirt work he needed, and he said if I bought it,
that's the first red flag there. When you're the only guy that can do it, okay, let me find out for sure about that, right?
Yeah, right.
Wow.
So after the family had moved into the home, it was painted beautifully. The home turned out beautifully. A friend of mine was there. They'd already moved their furniture in, and he noticed that the drywall was all wavy. And this is a large, beautiful home. And I called the buyer and said, I've got bad news. And so we covered all their furniture up, and we went back in. He didn't even notice it, but we went back in and we fixed all the drywall, repainted the whole interior. And that was kind of like adding insult to injury at the last point there. But I haven't built any more stick-built homes.
Wow. So, Paul, how many different types of real estate niches have you gone through, and which one is your favorite? Let's go through that. How many have you done? It seems like you've gone the whole gamut.
Yeah, so from about 2000 to 2002 or 3, we were flipping homes. Then we got into modular for about a year. Then we did the stick-built home. What I realized that the real value there was in the property. So we started buying waterfront lots. This was at Smith Mountain Lake, which is a resort area in the Blue Ridge Mountains of Virginia, where I lived. People had bought these lots for $10,000, $20,000, $30,000, sometimes $100,000 back in the 70s or 80s, and these lots were overgrown like little jungles. And we would buy the lot for, say, $200,000. We would clear it out beautifully, put a park bench on it, get a dock permit, and resell it for a $100,000 profit in a few months. And we did 20-some of those.
Wow.
Which led to one of my other big mistakes, and that was the cover of Fortune magazine. I think I still have it. Said the real estate boom is about to go bust, and that was it was either Inc. or Fortune magazine in 2005. I ignored it, and so I was holding a whole lot of waterfront lots when the market turned. And so my $2 million I had in the bank from the sale of my company in the 90s turned into a $2.5 million debt in 2008, and it was quite painful, but we were actually debt-free 13 months later, so I was able to sell almost all those waterfront lots.
Wow, that's great.
Yeah, so we went from there to took a few years off. I also started a website to generate real estate buyer leads. I have 6 realtors. I still keep busy with that at Smith Mountain Lake. In 2010, decided to invest in oil and gas. Like I mentioned, I had a petroleum engineering degree, and went to North Dakota. My business partner has a small jet, and every time he'd fly into the Bakken region of North Dakota, realized he had no place to stay. We were both involved in real estate at the time. We had built a very high-end, he had mainly built a high-end office complex that I was involved in Colorado Springs. So we decided, hey, we need to get involved in housing here for these oil workers. And so we built a beautiful multifamily facility in 2011. We filled it up in 2012, operated it in 2013, And we actually sold it at the height of the oil prices, when they were around $100 a barrel.
Yep.
People have a hard time believing this, but we were renting these 300 square foot units for up to $4,100 per month.
Sounds pretty sweet.
And what are they renting for now, though?
Actually, we decided we were going to build the nicest multifamily facility. A lot of people were slapping these, basically slapping trailers together. They were called man camps. You might have heard of that. We decided to build a really high-end facility. And so it's actually still 50% full, and they're still renting for, maybe $1,500 a month, which is far better than the competitors, which have just closed up shop.
So what do you see happening in that market right there in North Dakota? Is it ever going to come back, or are they just so hooked up with natural gas in that part of the economy?
Yeah, I think it will come back slowly if oil prices rise, which I think they're going to eventually. I'm really glad we sold at the top of the market. That was the best real estate deal I ever did. We actually we bought 75 acres with that, so we were able to sell the land, sell the multifamily facility, did really well at the top of the market. The epilogue to that is we decided, if that worked well, we should be able to do more. So we built a very high-end Hyatt House hotel. I believe it's the nicest Hyatt House, which is a competitor to Marriott Residence Inn. In 2013, we opened that in Minot, which is in North Dakota. It's got an airfield, it's got an Air Force base, and it's a lot more diversified economy. It's not just oil. But honestly, we're still struggling with that. It's struggling along. It's not going as well as we would have hoped. That's for sure.
And why do you think? Is it because of the economy, or is it because of the location, demographics, job growth? What do you attribute it to?
It's honestly just the oil. Minot was growing so fast, adding hundreds and hundreds of apartments, really thousands of apartments. Huge growth plan, going to double in size over several years. And when the oil price went down, the economy went bust. And so, although there are still people flying in and out, from Houston, Dallas, Baton Rouge, etc., who love Hyatt, and we still get a lot of people staying there, it's not ever what we thought it would be.
Wow. So how has your investment strategy changed over the last 5 years from that point to where we are today?
Well, like you guys, what I realized was that the demographics for multifamily are astounding. I mean, you guys know this, and I'm sure your audience has heard it a lot from you, but between the number of folks who are immigration is driving multifamily, baby boomers returning from home ownership to rentals, and millennials are driving the increase in multifamily. As you know, home ownership has gone down from 69.2% in 2005 down to about a more normalized number of 63% plus or minus right now. Every drop in percentage is 1 million more renters on top of the immigration, on top of the millennials who are forming new households. New renters outstripped new apartments at 7.7 to 1 ratio during the recession. So that leaves us with a situation where multifamily looks really good. Now, we obviously did a Class A multifamily in North Dakota. But what I learned from that is that there are opportunities in multifamily, but not necessarily in Class A. My strategy has changed. We, I believe, like you, really believe in the value add Class B multifamily strategy, and that's all we're doing now. We're looking for Class B garden style multifamily, 100 to 200 units or more, in really carefully selected markets. And so that's our strategy now, and don't ever plan to do Class A again. A perfect example of that, I don't have this month's statistics, but we looked at Asheville, North Carolina once, which is not far from you, I believe.
Very close.
And yeah.
You might want to do a hotel there. Their prices are outrageous.
They are. I know. I just stayed at the Grove Park Inn with my wife for our anniversary. So, but we looked at that market. They're in all the Southeast, they're showing the highest vacancy rate right now, which I thought was really strange. And so I drilled down into it a little bit deeper. Their Class B and C, if there are any C there, their Class B vacancy rate is about 1%, which is, effectively zero. Their Class A vacancy rate, because they have so many new units coming online south of town there, is like 17% last I checked. So they're showing a vacancy rate of 10.1% right now. But if you drill down into it, it's a perfect place for Class B. Class A, you have to have some cash to hold on a little bit to fill those up.
And that's what I've been, making the argument with a lot of the folks that work for us is that we're not competing with the new stuff that's coming on the market because we have, a lot of C plus, B minus type assets that are renting $600, $700, $800 a month. With this new stuff that's coming online, you're getting a small unit for $900, but a lot of times you're $1,200, $1,300 a month for an apartment. So it's a totally you can't build. You go back and build a Class B, Class C asset, right?
Right.
It's the existing inventory that's on the market. So you can flood the market with a lot of this stuff. The fear is that those prices get beat down because they can't fill them up and they don't know what else to do with them. That's when it gets scary. That's the fear. Right.
I know we only have 40 minutes or 45 minutes, but I'm going to give you my couple minutes on this. This is where the big problem is going to be because you're building an asset for 120 a door when you can buy a B in our market for 45 a door, and rates really aren't that much more for A's, to be honest with you. And if there's no job growth like Cleveland, where they're adding 2,000 additional apartments in the downtown, who's filling those up? That's the major problem. That's the major bubble right there. And for anyone listening, A properties are for wealth preservation, people who want to preserve capital. B and C's are for guys who want a little wealth preservation, the B's especially, and want the cash flow. So you have to know what you're investing in. I mean, we stay away from A's because we're not net worth guys of $100 million. We're not REITs, so that's not our model. And most of our listeners, I think, fall into that category where they want the cash flow, they want the value add, and they want maybe a little like cap appreciation. So I think the B's and the C's are primarily because we're trying to rebuild. Jake and I bought a property, 156 units, 16 units of it was burned down. We bought it at 45 a door. To rebuild it with the foundations, it was over about $90,000 a unit, and that's like after beating people up for prices. So we're going to rebuild something and maybe get $100 a month more for rent than what we have right now. It just made absolutely no economic sense. And these guys are building it. I know money's cheap. I know labor's there, but that's where the next bubble is going to be in the A assets.
Right.
I think so.
Right. I agree.
And if because the thing is, there's not enough people, I don't think, at least in our market, to fill all those A's because they may be capped out $25, $30 an hour. So they may not want to spend $1,400 a month on an A asset. So if they can't fill them up, do they drop their prices? Where do these things go? Do they default? That's kind of the wild card for me right now. But.
Right. And that points out another thing I love about multifamily, and that is that I've got some graphs in my book that show that rents actually continue to rise in general through the recession while incomes took a huge drop.
Because of demand, supply and demand.
Supply and demand. And also the obvious fact is that a lot of folks, a lot of baby boomers and such my age, were losing their homes.
That's what I mean. So the demand went up. Yeah.
Right. So the demand went up, and where are they going to go? They just lost their home. They're probably not going to go into a $1,700 a month Class A. They're probably going to go into an $800 a month to get back on their feet. So actually, rents continue to rise while incomes dropped during the recession. And that's actually been the case for the last 51 years as we've looked at these statistics.
That's a great point, Paul. I like that point. Let me ask you two-part question. How do you analyze a deal? What do you look for in a deal, and what markets are you really trying to really hone in on?
Okay, so as far as markets, we have about an 18-point screen we go over, including job growth, net domestic migration. We don't look so much at income growth because a lot of our renters, are not in high-income jobs. But we look at that. We look at the diversification of the economy. We want to make sure it's not all tied up in one employer like we did in North Dakota.
Yes.
We generally are looking for markets that have over 400,000 people in the market, and that would be a bare minimum. One reason for that is that obviously we want a place where there's a lot of, deals changing hands. We don't want a place, where there's only a few deals coming up every couple of years. We want a nice steady flow of buyers as well as sellers, though, on the other end.
Mm-hmm.
So Knoxville, you can rule that out. No, it's just
right?
there's not a lot of deal flow here. It's especially some of the submarkets. But sorry, carry on.
No, that's good. Actually, that's good to know. Asheville is kind of similar to that, But another less obvious reason is we want to get a couple of options on a property manager. We want a professional property management company. And if there's only one great option and we have them, we don't have anybody else to turn to if it goes bad.
Right.
Mm-hmm.
So we're looking for a market, like Charlotte, that has several great options for property management firms. So we're actually looking at Dallas, Charlotte, San Antonio. We weren't looking at Raleigh-Durham because they're that's another factor. They had a little bit too much supply there for a while, and I think that they've come back into balance. But Indianapolis is another market like that had maybe too much supply, but they seem to be back in balance from what I understand. We'd love to look at Nashville. We've heard it's very hard to get into the market.
It's really hot right now. Yeah, they're building a lot. It's the oversupply. Yeah, the supply in there with the A's. It's the same thing. They're having to give a lot of concessions on those A's, and it's a really emerged market. The market emerged a couple of years ago. And we've got a lot of brokers from Nashville coming into the Knoxville market, and they're trying to price it, and it's not. It's comparing like the city, New York City, up to the suburbs. Is not. They really can't. It's like comparing apples to oranges. It's not the same type.
They're getting a ton of people every day, though, man. That city is expanding rapidly.
Yeah. Right. So our our management partners just closed on a deal in San Antonio, so we like that. Houston is surprisingly, especially East Houston, is surprisingly strong considering what's happened there with the obvious drop in oil prices, but we're a little bit cautious on Houston right now. Those are the markets we like real well. There are some smaller markets we would consider, like I mentioned, Asheville, Wilmington, North Carolina, Columbia, South Carolina, some great things about all those markets. We are close to Roanoke and Lynchburg. The markets are way too small. Richmond is not far from here. Richmond supposedly has only about 5 families that trade assets back and forth every decade.
They're just juicing their cost seg to one another. They're playing a little cost segregation game there.
That's right, exactly. Right. So those are the markets we really like.
Let me ask you about Louisville. I have a student who's in Louisville. Have you checked Louisville out as a market?
Yeah, we have. Actually, they're on our list. We haven't looked carefully at Louisville or Lexington, but our asset management partners just had a deal called Heritage Hill, I believe it was, in Louisville. And they just got an offer for, I believe it was $1 million higher than they thought the property was worth, and they sold it.
Wow. And as far as San Antonio is great. I have a student who's in San Antonio. What he likes about it is the economy is diversified. It's not like Houston where it's really on oil. He likes the San Antonio economy. Right. And also he says it's really growing. He says there's a lot of assets. He's having a little trouble getting traction into it, but he says the market itself, it's a big market, and he likes the market, San Antonio. So I agree with you on that market also.
Right.
And as far as analyzing these deals, what do you look for in these deals as far as maybe cash on cash or IRR or any other parameters?
We're looking for value add opportunities, and we're generally looking for a 5 to, starting out 5% minimum cash on cash, hopefully 6 or 7, up to, hopefully 8 or 9 or 10% cash on cash, IRR between 15 and 20%. Total return between 16 and 22% annually, of course. Something that became clear to me the other day, and especially being someone who flipped, 60 or 70 homes, I haven't put a pencil to this, but I've got a sense that, and you guys know this, but the beauty of multifamily, one of the great beauties of it versus flipping residential real estate, if I change out a kitchen in a home that I'm flipping and spend $8,000 on it, I might get something like $15,000 increase in resale, right? Mm-hmm. One time. But if I spend $8,000 renovating an apartment, I get the compounded leverage effect of the NOI and cap rate growth, which is far, far greater. And I mean, just that direct apples to apples comparison, where do I want to invest my $8,000 upgrades? Residential or, large scale multifamily? Multifamily kills it.
I
Long
like
term,
that.
baby. Looking for that paycheck every month.
Right.
Paul, you've expanded the last few years, and from what I hear, you've got a great entrepreneurial story. How have you built your teams, and how are you building your company, going forward as far as being able to scale your business?
One thing I've learned is that it's really easy to try to bring together a team of people who are very similar, all entrepreneur, type A, startup type guys, because we get along well. But what I've learned is that's not always the best fit. In fact, I've done a number of other businesses, that we've either sold or shut down over the years that have, went marginally well. But I've done some of those with another guy who is exactly like me. And we found that in analyzing deals, we, basically had the same rosy view of some of the things that we should have been more cautious or skeptical about. So we've pulled together a team now of people who are very different. I just brought on a guy named Wade Myers. Wade has raised money for about 53 deals over the years. He raised $15.5 million for the Woodlawn football film, in fact, that came out about a year ago. It was a faith-based film. He's raised money. He actually he's going to be on my podcast soon. He's going to tell us how he burned through $72 million in a .com startup that went south. So he's had a lot of pain. He's had a lot of great deals. He's the owner of the seventh largest property management company in America. He's actually the founder and the chairman. He's not the sole owner, but he's very different from me. He looks at things differently. And I think that's really important. As far as bringing on younger interns, what I'm learning is sometimes it pays to give them some tests early on. It's great to meet a young guy. I'm in the same town as Liberty University here, so we got a lot of young people all over the place. It's great to give them small tests early on, and sometimes to even give the same job to two different people and let's see who does it on time, who does it well, who keeps their word. I'm learning that can be a great way to build a team and to bring on young people because, again, sometimes my affinity for somebody does not necessarily equate to them doing a great job later. Mm-hmm. So I've got a couple young guys on the team right now who are doing a fabulous job, but we gave them some small tests early on.
That's great. Let me ask you one last question in our long story. What is the best real estate investing advice or tip that you have for the listeners?
Well, I was when I was into oil and gas in 2010, I went down to Austin, Texas, and that's another market we like, except a little concerned about being overheated. Cap rates are in the fives, and it just doesn't make sense for us right now. Mm-hmm. Maybe it will again. But I was meeting with a guy who owned a small oil company in the Lakes area west of Austin there. And in his best Texas drawl, I said, how do you find deals? How do you find new partners to work with? Not investors, but geologists, partners that basically people bring him deals all the time. And he said, if I see a fly buzzing around, he said, I know there's some manure, he didn't say manure, down beneath. And he said, I run immediately. He said, I don't care how good the deal looks. I don't care how the numbers stack up. I don't care how perfect the geology looks. He said, I immediately walk away. And I said, what do you mean? He said, if I sense, you mentioned NLP. Apparently there are something like 2,000 to 3,000 body language signals and cues, from vocal cues and all kinds of things that almost seem supernatural to me, where we can pick up something's wrong. And honestly, I'll tell you, my wife's way better at that than me. But if you pick up something is wrong, in a deal or in a person, or if there's some inconsistency, something that just doesn't seem right, follow your gut, put your gut ahead of your brain, and especially put your gut ahead of your greed and your natural desire to make a profit. It doesn't even have to be greed, just can be a desire to make money, and walk away. That's my best advice. I could elaborate on that, and I'd actually elaborate that. I have a whole chapter in my book dedicated to that concept.
Wow.
I think it's pretty clear. I mean,
yes.
Really, that's pretty good advice. So let's pause for a quick commercial break.
Are you stuck on the sidelines experiencing analysis by paralysis? Are you still trying to get your first multifamily deal done? We've never met an investor who's only done one deal. People are either stuck on the sidelines or they've done multiple deals. We always say that it's education times action that equal results. You've come to the education side of the equation. Let us help you land your first deal. Call Jake and Gino today at 904-314-9473 to set up a strategy session, or email us at gino@jakeandgino.com.
Woo! Love that guy. Now back to the show. So what would you say your best habit for success is?
I am a highly driven, type A, running all day. I mean, if I get into a movie theater, my wife calls it an $11 nap for me because when I slow down and actually sit in a dark room, I fall asleep because I'm going so hard, so fast all the time. So I've come up with a discipline where I actually sit quietly and meditate and pray every morning for, my goal is an hour every morning. And
wow.
That is the best habit I have, I think, just seeking wisdom and trying not to just be running from the moment I would get out of bed, even though it's tempting to.
That's serious dedication right there. That definitely is a good habit. Every morning, huh?
I try.
Wow, that's great. So you've been around the block. What would you say your favorite book is? Are you a reader? Do you have a business book that you say that's really helped you out?
Yeah, well, this was my favorite book for a long time. It's Curious George. But then that was a joke.
No, we got to know why, though. You can't just put it up there and just tell us Curious George.
Well, he flies a kite, okay? And I just really like flying kites. I did as a kid, and it's just a really good read. And George is... Seriously.
For the YouTube guys out there, he's got it.
Yeah, right. No, Made to Stick. My favorite authors, Chip and Dan Heath. They do an amazing job. They only have 3 books out. Another one is called Switch, and another one's called Decisive. I like them all 3 about equally. Made to Stick is a great book because it helps frame. It teaches you to frame everything in dramatic stories. And what I've learned is that people remember stories. You've heard it 1,000 times. Numbers tell, stories sell, and they do an amazing job from the first page, just getting your attention and drawing you. And I even though I first read this in 2011, I still remember in somewhat detail from that read what I read.
Storytelling isn't easy either. That's a good one to check out. Gino, you read that one?
I didn't know, but I'm going to read it. I like that because we always want to convey our message, and if you can convey your message in that and give people pictures, make pictures vivid, add a little music into the pictures, it lets people remember. It gives them more of a memory. And another tip for everybody: you got a big problem. Let's say, Jake, I was just learning this yesterday. Take a picture of that problem. See what's going on in that picture and that problem. Shrink that picture down in your mind. Just shrink it. Make it smaller, 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 and then push it away in your mind. Get rid of that picture as far as you can. Sit back, do some meditating like Paul, do some praying like Paul. Then you can think about that problem. That problem will seem a lot smaller to you. You'll come up with a lot of other reasons of why that problem is not such a big problem. You come up with some reasons on how to solve that problem. Then you can think more clearly. But I think pictures, I think that book is going to be awesome. I'm going to check that out. So, little NLP technique.
That's a great book. I got to tell you, that's fabulous. And I've got to give you an advertisement for their second book, which I don't have in front of me, but it's called Switch. And
is that the light switch? Or is that a different book?
Yes.
I've read that one.
Blue book with a light switch on the front.
Okay.
There's a chapter in there about that. He doesn't mention NLP, but he mentions shrinking the problem down to a very small size. And he talked about how they solved the hunger, the starvation problem in Vietnam, a guy who had no background in feeding or caring for orphans or whatever. He more or less solved the whole problem in Vietnam in the 1980s by shrinking it down to figure out, wait, how do I feed one child? And then he took that and he mushroomed it back up, and they basically solved the starvation problem in about a year or two in Vietnam, from what I understand. And that's in the book Switch, which is a great book by Chip and Dan Heath.
But don't you think that's incredible? It's all about our beliefs, and if we can believe we can do it, and we can shrink it down. And unfortunately, a lot of us get caught into this believing, having these limiting beliefs that Jake and I talk about, that you can't do it. If you think you can't do something, I know you're not going to be able to do it. But if I can, coach somebody and have them see the opportunities or the possibilities, then the sky's the limit. Then you'll be able to believe it. And once you can believe something, you'll be able to take actions towards it. And it's just a powerful technique. It's really amazing.
Yeah, it's absolutely true. And my brain's firing with all kinds of little stories to add into here, but I know we're about out of time.
What project are you excited about right now?
Well, like I said, we've kind of regrouped. We decided, we've noticed, as you have, that it's very hard to get deals in multifamily right now. It's really hard to get good deals. It's hard to get off-market deals. There's going to come a time in the very near future, I think. Right.
Yep.
There's going to come a time when the cap rate stops compressing. I think it probably already has, and it starts expanding again. And I think it'll be a little easier to get deals, but we're looking to, we have realized that as we compete against these larger companies who have, decades of experience and hundreds of millions of dollars of assets under management, honestly, it's so much who you know. I tried to buy a piece of land to build another Hyatt hotel in Houston in 2000, I think it was 12, and the broker wouldn't even return my calls because he didn't know who I was. I thought, doesn't he know who I am? Exactly. He didn't know who I was. But anyway, so we've regrouped. We decided to put together a fund, and we're pulling together a lot of friends, family, other people, and hopefully others in the near future. And we're putting together a fund where we can actually go in with cash. And doesn't have to be necessarily an all-cash offer, but we're going to go in a lot stronger than we are now with, the way we have been, which is needing to raise the money. Even though we're confident we can raise the money, it's so much better to go in with a fund, show the broker, show the seller what we have, and we're hoping to get much better access to deals in the next year or two than we've had in the past. So putting together the fund is the most exciting thing I'm working on right now, and I'm also doing a podcast, as I mentioned before.
That's awesome.
Let's talk about the podcast a minute, but I want to elaborate on a point that you just made for the listeners because it's so important. People think of, especially when they're getting into the game, they think, okay, a broker is a real estate agent. They need to sell me on why I want to buy the property. Pump the brakes right there. That is not the case. You are the salesman. You are selling the broker in a compressed cap rate environment. Why you're the closer, why you're going to get the deal done, why you have the credibility, why you're the man or lady that's going to get the deal done. That's a mindset shift that people need to understand because it's a competitive environment. If you want the deals, you better be taking these brokers out to lunch, showing them your credibility kit, why you're going to get the deal done, what your background is like, and you better be a nice guy, because it's just that's the environment that we're in right now. So that's very important.
Right.
And to piggyback on Jake, what you're doing, Paul, is you have the confidence to be able to put in an offer. You already know you have the money secure, so that gives you the strength and the confidence to actually go. And I think people overlook that. It's like our partnership, Jake and I. We're confident that we can get a deal done because we're together. We've got more capital. We've got 2 balance sheets. So when you're already coming to the table and you already have some money behind you, backing you up, you're going to have more confidence in presenting that deal. And that can't be overlooked. I think people really overlook that. And then they start scrambling for money. But if you're already coming with capital and with that credibility, it makes the deal a lot easier to secure. So
right.
And then on the next deal, because what's going to happen, the seller's going to say to Mr. Broker, have you done a deal with this buyer before? No. So you got to it's going to be hard to get in that first one. You get that first one done, then the question is, Mr. Broker, have you done a deal with this buyer? Yes, they were closers. They got it done efficiently. They didn't bust my chops. It was a clean transaction. They're ethical.
Right.
All that, and then that goes into your credibility book, and you start building a good business reputation. So.
Right, and that brings up another point.
Man. I'm going to slow down.
Well, and that brings up another point. We don't want to do a lot of retrading later. I mean, we just don't want to get a reputation.
Get the number right on the front end. Fantastic.
Yes, absolutely.
So let's talk about this podcast because I know a guy, Gino, who's a great guest for podcasts. So tell us a little bit about what this is going to be about here.
All right. Well, as I scoured the podcasts out there, there's so many great podcasts like yours that are about wealth building and wealth creation and how I made millions in real estate and all that. And we love those podcasts. I've gotten so much out of yours and others. What I hadn't heard a whole lot of is failure stories. Yet when I hear people speak live, I think I remember the story of like my friend who lost $72 million and had to make that painful call to Michael Dell, one of his investors,
that hurts,
and tell him what happened. He burned through up to $6 million a month, more than most Americans will ever make. And I feel like failure stories are more tactical in nature, and whereas success stories can often be hard to replicate. For example, the other day I heard about a guy who was sitting in an airport, met an Asian guy who sat down next to him. They had a long conversation, stayed in touch, and the Asian guy eventually sent him $2 million to invest in a startup. And he leveraged that into a multi-million-dollar fortune, paid the guy back, and he's just had this amazing story. Guys, what do I do with that? I mean, do I go sit in an airport now waiting for an Asian guy to walk up? I don't know. How do I replicate that?
You could try.
I can try. I'll think about it. But if I had heard how he failed to do due diligence on a deal, or he failed to check someone's background who stole his bulldozer or something like that, I can actually apply that to my life. I can go, okay, remember
put a GPS tracking device on the bulldozer when you buy it. Check.
Right. That's right. So we came up with this podcast idea to interview highly successful people about their past failures, losses, relationship breakups, money losses, pain, bad deals, and ask them to tell our audience how this happened, how this came about, what they could have done differently, and what they learned. And so we called the podcast How to Lose Money.
Well, it's a catchy title, that's for sure.
Jake, I could be a guest star in that podcast, bro.
Mobile home, baby. We'll talk about it. So
yeah.
Too?
Yes.
I got home stories.
Oh, man, let me tell you, be another 45 minutes on this show, but it's a painful story, and I can relate to that because it's hard to be humbling. You have to be humbling and eat your humble pie, but at the same time, there's a lot you learn from that, and that makes you a stronger person. And you can do one of two things: you can quit, or you can go away from the pain like I did and get motivated and motivate yourself to learn something else. And that's what I ended up doing. And fortunately, I did that. I really got my education. I didn't know what due diligence was. I didn't know what an operating agreement was back 10, 15 years ago. And I forced myself. And if I had heard everyone else saying, well, real estate's risky, they're right. But it was all upon me. It was all of my limiting beliefs, why I screwed up. And a podcast like yours is going to be truly valuable for the millennials, because there's a lot of millennials out there who are crushing it, who want to crush it. They're not basement dwellers. That's a myth. I think that's a total myth, because I've talked to a lot of them. They want this knowledge. They want to hear. I wrote a blog on what I would do when I was 30 years old. I look back at my 30 years old. Get out of the rat race. Become financially independent. Learn my mistakes. Learn what I did wrong, and then apply it. And then once you're financially free, you can do anything you want. Sky's the limit for you. So
I agree.
Boom shakalaka.
Sorry, Jake. I'm bringing the pain. I didn't mean to.
Bring it, baby. Come on now. Pump that chest. Oh. So I just wanted to say a few more things. I just was so amazed at how many different niches and parts of the real estate sector that you've touched. It's just crazy. So you've really, I'm going to run the gamut on that. You said yourself, but pretty cool. I totally agree, and this is a point that you made earlier, that we're becoming a renter nation, and that's one of the best reasons why multifamily right now. Sell the broker on yourself, not the other way around. I think your podcast is going to accelerate the process for folks, because when you can hear, okay, this guy screwed up here, I'm not going to make that same mistake, and you hear those stories, okay, not going to do that one, right? Accelerate the process, accelerate the education for people. The other thing is, these failures made these entrepreneurs, made these business people who they are today. And I think those war stories are going to be extremely valuable.
Right. I agree. Thank you. I appreciate it. We're launching it next week. We've got our first couple episodes already recorded. We talk about Steve Jobs, being fired from Apple, what he learned by plowing millions of dollars into the Lisa project, maybe one you don't remember.
Mm-hmm.
Now I've watched both movies, read the book, so I'm pretty
okay. Yeah, good for you.
Love the book, by the way.
We talk about Oprah being fired from her first job. Walt Disney was told he had no creative ideas and lacked imagination when he got fired in St. Louis.
That's a funny one, right?
And shaken down by the debt collector, right?
Uh-huh.
Right. Yes.
Yeah.
Walter Isaacson is the Steve Jobs book I'm referring to, though. It's excellent. Must read.
Yeah.
So,
Right.
Paul, let me ask you: how can people get in touch with you? Websites, books. Give us the whole gamut.
All right. You can get in touch with me at wellingscapital.com. That's WELLINGS capital.com. We will also be launching our new website, howtolosemoney.com. It's already in the works. You can reach me at also at paul@wellingscapital.com. I've got a book. I've got a book on. I've got 2 books on real estate investing. The new one is available on Amazon. It's called The Perfect Investment: How to Create. What is it? Create enduring wealth from the historic shift to multifamily housing.
Very cool.
Great book. Yeah, it's a great book.
Thanks. Available on Amazon or at wellingscapital.com. Thanks.
Go get
Great.
it. Go get it. So, hey, Paul, great job. Really appreciate you being on the show today.
Paul,
you.
thanks for your time. Appreciate it. I had a great time.
Me too. Thanks a lot, and we look forward to having you on our podcast soon.
Thanks, Paul.
We trust that you enjoyed the Wheelbarrow Profits podcast. Visit jakeandgino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.